So imagine you're just sitting in a skyscraper.
Right.
And suddenly the fire alarm just blares.
Oh, the worst.
Right. Everyone scrambles outside. You're standing on the sidewalk, heart pounding. And then 10 minutes later, the alarm just abruptly shuts off.
Just like that.
Yeah. No fire trucks arrive. There's no all-clear signal from the fire department, and you can't actually see if the smoke is cleared up there. But everyone just starts cheering, high-fiving, and sprinting right back inside to their desks.
Wow. Yeah, that's a pretty reckless move.
Exactly. And the crazy thing is, right now, that is exactly what the global financial markets are doing. They're pricing in absolute peace simply because the noise stopped.
Yeah.
And they're walking right into a massive hidden trap. Welcome to today's deep dive, everyone.
I mean, the contrast between the underlying reality and the market's reaction right now, it's staggering.
It really is.
Yeah.
So our mission today is to unpack this really fascinating and honestly slightly alarming strategy dispatch, dated June 24th, 2026.
Right, titled The 60-Day Assumption.
Yeah. And this memo pulls together insights from the biggest players out there. We're talking Goldman Sachs, BlackRock, JPMorgan, Merrill Lynch. And it places their current, absolute euphoria right next to these severe structural warnings from Gramercy and the IMF.
Because the core theme here, and what we're going to be exploring today, is how the market is systematically mispricing ambiguity.
Yes.
They are taking these incredibly volatile, totally unresolved situations and basically treating them as if the ink is already dry on a permanent solution.
Right. They're taking a deep breath when they really shouldn't be. So let's start with the immediate catalyst for this massive market high five, which is the Iran Memorandum of Understanding.
Right, the MoU.
Yeah. On paper, Tehran signed a framework. And the reaction was just an absolute jubilee. I mean, Brent crude oil fell below $80 a barrel for the first time since March.
Incredible.
The S&P 500 gained nearly a full percent, and the MSCI Emerging Markets Index surged over 4%.
And the narrative taking hold everywhere is just one of complete relief. Goldman Sachs documented how global markets are now operating on the prospect that energy flows will just normalize.
By the end of July.
Right, by the end of July. BlackRock is maintaining overweight positions on U.S. equities, arguing that the energy challenge has shifted from, an immediate crisis to just a long-term infrastructure project.
Which is wild.
It is. And JPMorgan Asset Management is out there pointing out that 85% of S&P 500 companies beat their first quarter earnings expectations. They're projecting this massive 22% earnings per share growth for 2026.
Okay, let's unpack this because it sounds like the market is celebrating the end of a marathon just because they filled out the registration form.
That's a great way to put it.
Because the memo points out that actually demining the Strait of Hormuz, that alone is going to take 30 days before a single commercial tanker can safely pass through.
Well, the registration form analogy gets us halfway there, but what's fascinating here is that the reality is actually much worse. They haven't even agreed on what the marathon route is.
Oh, right.
The physical logistics of demining are just one barrier. Geopolitically, this memorandum of understanding only opens the strait on paper.
Right.
It pushes the actual nuclear terms into this 60-day negotiation window.
Right. A 60-day window isn't a resolution. That is a ticking clock.
Exactly. Which is entirely missing from the pricing models right now. The market is treating a 60-day negotiation for nuclear terms and a completely undefined maritime security regime as minor implementation details.
Wow.
They're looking at these binary risk scenarios that could either stabilize the region or trigger a massive escalation and pricing them as if long-term success is just a mathematical certainty.
Merrill Lynch.
Oh, yeah. This part is wild.
So their June 22nd Capital Market Outlook recommended an unqualified overweight on U.S. equities. And their primary reasoning,
You're going to love this.
America's 250th birthday.
Right.
They literally cited national entrepreneurial DNA as a structural tailwind to justify buying stocks.
Which, using patriotism as an investment thesis is a classic way to obscure an uncomfortable underlying reality. Because if you read deeper into that exact same Merrill Lynch report, their actual economic forecast projects that the federal funds rate will rise to 4.38% by the fourth quarter of 2026.
Okay, let me make sure I'm visualizing this correctly. They are telling clients to aggressively buy stocks because of the American spirit.
Yeah.
while their own analysts are predicting that the cost of borrowing money is going to jump by 75 basis points.
That is the structural contradiction right there. Because when the Federal Reserve raises rates, capital just gets more expensive. Companies pay more to service their debt, which eats right into their profit margins.
Right, basic economics.
Exactly. Plus, higher interest rates mean investors can get a better, safer return on government bonds, which typically forces stock valuations downward to compete.
Right.
So Merrill Lynch is basically implying that this entrepreneurial DNA will somehow magically absorb a 75 basis point tightening cycle without any negative adjustment to stock prices.
Okay, so if the narrative is completely decoupled from the math, let's actually look at the math itself.
Let's do it.
Because the exact mechanism that proves this whole blind optimism wrong is sitting right inside the U.S. Federal Reserve. I mean, we are in a brand new monetary policy regime under the new Fed chair, Kevin Warsh.
Yeah.
And it seems like the markets haven't realized that the rule book was just completely thrown out.
The policy shock here is profound. I mean, at his very first meeting as Fed chair, Warsh completely eliminated forward guidance.
Which, for those listening who might just follow the headlines, forward guidance is essentially the Fed's way of communicating its future intentions.
Yeah,
right?
exactly.
It's the dot plot. It's the central bank telling the public, here is where we think interest rates will be in 6 months or a year. Historically, it gave markets a roadmap to price in future risks.
And Warsh has deliberately burned that roadmap.
Wow.
He flatly refused to submit a dot for the dot plot. And beyond that, the Federal Open Market Committee is currently split exactly 9-9 on whether to hike rates further.
A dead tie.
A dead tie. And yet, even without official forward guidance, the median year-end expectation actually shifted up to roughly 3.8%.
Reversing earlier cuts.
Completely reversing the rate cuts they had projected back in March. Warsh is implementing this hawkish posture, meaning, prioritizing fighting inflation through higher rates, but he's doing so with zero transparency about the ultimate destination.
Wait, before we talk about how Warsh basically broke the bank's models, you got to define term premium for me.
Sure.
Because the dispatch notes that credit models require an anchor for their term premium assumptions. What exactly are these models anchoring?
It's a great question. So think of term premium as the extra compensation an investor demands for locking their money away for a long period of time.
Okay.
If you lend me money overnight, your risk is pretty low. But if you lend me money for 10 years, you face inflation risk, default risk, opportunity cost.
Right. A lot can happen in 10 years.
Exactly. So you need a baseline expectation of what the safe, risk-free interest rate will be over that decade to calculate how much extra yield you need to justify taking on that risk.
So if there is no forward guidance, if Warsh is literally refusing to provide that baseline and the Fed is split right down the middle, how on earth are banks projecting exact economic numbers for the end of 2026?
It shouldn't be able to.
But the memo shows Goldman Sachs projecting 3.6% headline inflation and Bank of America forecasting core PCE at exactly 3.1%.
Right, and they are projecting those numbers by just pretending the old regime still exists.
I'm kidding.
Nope. Warsh deliberately removed the anchor to force markets to assess risk independently, rather than relying on the Fed to hold their hand. But credit models are mathematical algorithms. They cannot compute ambiguity.
I need a number.
They need a hard number. So the banks are simply plugging in assumed certainties just to prevent their models from breaking. They're pricing an absolute stable path into a system that the Fed chair specifically engineered to be unpredictable.
That is terrifying. And if the baseline math is broken at the U.S. Federal Reserve, how does that impact the rest of the world?
Right.
Like if the anchor is gone in the U.S., what happens to the countries that rely on U.S. stability?
Well, this is where the dispatch shifts to emerging markets, and the picture gets incredibly bleak.
Yeah, it connects directly to a warning issued in the IMF's October 2025 World Economic Outlook. The IMF pointed out that emerging market frontier credits basically built their entire refinancing survival strategy on a foundation that just doesn't exist anymore.
Right. During that golden era of the 2010s, emerging economies borrowed heavily in U.S. dollars and other major currencies because interest rates in developed markets were near zero.
Yeah, money was basically free.
Exactly. Their survival math depended on those rates staying low and predictable.
But the reality today is this synchronized, global, hawkish posture. It isn't just Kevin Warsh and the U.S. Fed. The European Central Bank has hiked rates. The Bank of England has dissenting voices pushing for tighter policy. And the most crucial detail of all, The Bank of Japan has officially hiked its rate to 1.0%.
And that Bank of Japan detail, that changes the physics of global finance.
Really? Just the Bank of Japan?
Oh, absolutely. For decades, Japan's zero or even negative interest rates served as the ultimate funding floor for global debt. It was the cheapest money in the world. Now that the BOJ has hiked, that zero-bound floor is just gone. The underlying cost of capital for the entire planet just structurally increased.
Wait, hold on. 1.0% is still incredibly low by historical standards. So why is a tiny move up to 1% causing this much panic for emerging markets?
Because of the massive scale of the carry trade and the specific currency dynamics happening right now.
Okay, let's break down that carry trade mechanism.
Sure. Historically, major global funds would borrow massive amounts of Japanese yen because the interest rate was virtually zero. They would then take those yen, convert them into US dollars, and invest in higher-yielding assets like US treasuries or emerging market bonds, and just pocket the difference.
Okay, so it's basically like taking out an incredibly cheap mortgage in Japan and using that money to buy a high-yielding rental property in the United States. You make your profit on the spread between the low mortgage payment and the high rental income.
That is the exact mechanism. Spot on.
Thanks.
But here is why that 1.0% hike is so destructive today. The BOJ voted 7-1 to hike, framing it as a guard against energy shocks causing inflation.
Which signals they might do it again?
Exactly. It signals a strong institutional consensus for even more hikes. So your cheap Japanese mortgage just got more expensive. And normally if Japan raises rates, the yen should strengthen against the dollar. But currently, the yen is still sitting weakly at roughly 161 to the dollar.
Oh, wow. Which creates a devastating double whammy for any emerging market that borrowed in that structure.
Yep.
Your interest rate, your mortgage payment basically just went up. But simultaneously, because the US dollar is so strong, the currency you have to use to pay off that debt just got way more expensive to acquire.
The trap has fully snapped shut. For frontier sovereigns who funded their long-term projects through these yen-linked structures, the double cost is fully operational. It is no longer theoretical risk. It is a mathematical reality bleeding their reserves.
And we are seeing the actual on-the-ground casualties of this right now. Let's move from the theoretical math and look at how this panic is manifesting in a country like Indonesia.
Yeah, Indonesia is currently trapped in what Gramercy calls a feedback loop.
A feedback loop.
Right. To defend their currency against these global pressures, Bank Indonesia just executed its second consecutive rate increase. That brings their cumulative tightening to 100 basis points in just 6 weeks.
6 weeks.
Including an off-cycle emergency hike.
That is a brutal downward spiral. How does a central bank even begin to break that loop?
It's incredibly difficult because the defense mechanism actually causes the next wave of damage.
How so?
Well, when Indonesia implements emergency rate hikes to stop capital from leaving, they drastically increase the cost of borrowing for their own domestic businesses. That chokes off local economic growth.
Right.
And when index providers like MSCI see that growth stalling, they issue a reclassification warning, essentially downgrading the country's investment profile.
And the memo notes that Indonesia got hit with an MSCI warning right in the middle of this defensive tightening cycle.
Which triggers the next phase of the loop. Massive global index funds are often governed by strict rules, right? So if a country gets downgraded by MSCI, these passive funds are mathematically forced to sell their holdings. That forced selling accelerates capital flight, which puts even more downward pressure on the Indonesian currency.
Which then forces the central bank to hike rates again.
Exactly. Breaking that cycle requires global pressures to ease, but as we just discussed with the Fed and the BOJ, those pressures are structurally increasing.
Wow. And then you have the Philippines, trying a completely different strategy that seems, honestly, equally dangerous.
Oh, the duration trap.
Yes. They just issued a $2.5 billion three-tranche sovereign bond, and one of those tranches extends all the way out to 2051.
Yeah.
Why is issuing debt that far into the future a bad idea right now? Didn't countries do this all the time a few years ago?
They did, but if we connect this to the bigger picture, doing it in 2020 versus 2026 are two completely different realities. Issuing a 30-year bond a few years ago meant locking in historically low rates for a generation.
Right, smart move back then.
But issuing that same bond today is a massive duration trap. The Philippines is extending its maturity profile out to 2051 at the exact inflection point where global funding costs are structurally rising.
Oh, I see.
They are locking in a significantly higher interest rate for the next 25 years, meaning they'll be bleeding national capital just to service that debt long after this current crisis has passed.
But the dispatch does note some headline wins in the emerging market space. I mean, local currency debt in Egypt was up over 7%, South Africa was up nearly 5%, and Colombia's local debt gained nearly 6% in a single week, with their EMBI spreads compressing to 229 basis points.
Right. But before we celebrate those numbers, we need to unpack what an EMBI spread actually is.
Okay, lay it on us.
EMBI stands for Emerging Market Bond Index. The spread is essentially the premium, the extra yield that these countries have to pay over safe U.S. treasuries to convince investors to take on their risk.
Got it.
So a compressing spread down to 229 basis points implies that investors feel extremely safe, that default risk, currency risk, and refinancing risk are all totally contained.
But the Gramercy analysis points out a massive caveat to those gains.
Right.
They occurred almost entirely through the FX channel, meaning the actual credit quality of these countries didn't improve.
Not at all.
Gains were just a mirage caused by the U.S. dollar dipping briefly on the Iran news. Once the dollar surged back up to a one-year high later that week, those headline gains started evaporating.
The underlying fundamentals didn't change at all, just the exchange rate of the measuring stick. And Colombia is perhaps the most glaring example of how irrational the market's pricing of risk has become.
Let's talk about Colombia because this perfectly encapsulates the core theme of mispricing certainty. Colombia faces a presidential runoff on Sunday between conservative Abelardo de la Espriella and leftist Ivan Cepeda. And we need to make it absolutely clear to you, the listener, we are absolutely not taking sides or endorsing either candidate here.
Yeah.
Our goal is simply to report on what the market is doing with this information.
Exactly.
Because the purely mathematical reality is that an election is a binary event. It's a coin flip.
And yet, the market is acting like it already knows the winner.
Yeah.
By pushing Colombia's local debt up nearly 6% in a week, investors have effectively priced in a highly constructive, business-friendly outcome. They are aggressively building positions immediately ahead of a binary political event with absolutely zero margin of safety.
So if the election results in a policy shift that the markets don't favor, that constructive outcome they priced in reverses instantly.
Instantly. It violates basic risk discipline. The market is pricing in absolute certainty where there is only a 50-50 probability, and they're doing this globally. The baseline assumption for emerging markets right now is that risks are safely contained, but the IMF's own framework proves that global borrowing costs and currency pressures are actively deteriorating.
So what does this all mean for you? If we synthesize everything from this dispatch, what is the ultimate takeaway? The global market is essentially looking at a 60-day administrative pause in the Middle East and calling it permanent peace.
Yeah.
It's looking at a completely unpredictable Federal Reserve and projecting exact inflation numbers to the decimal point. And it's looking at the Bank of Japan raising the global floor for borrowing costs while pretending emerging markets won't feel the squeeze.
The author of the strategy memo brings up a brilliant concept from the legendary investor Howard Marks to summarize this exact phenomenon.
Oh, Howard Marks, yeah.
Marks warned about a very specific cognitive trap in finance: the widespread, dangerous belief that a resolution has occurred, when in reality all that has happened is that known risks have simply been replaced by ambiguous ones.
Wow. The known risk of immediate conflict was replaced by the ambiguity of a 60-day negotiation window. The known risk of the Fed's dot plot was replaced by the ambiguity of a Fed chair refusing to provide any roadmap at all.
And as we said, mathematical models cannot calculate ambiguity.
Right.
A credit model needs a concrete number to function. Because the market cannot quantify the ambiguity, it has simply erased the risk premium entirely. The premium for uncertainty has vanished from global asset prices at the exact historical moment when uncertainty is actually at its absolute peak. The answers will arrive in the next 60 days, but the market has already spent the reward.
It is the exact equivalent of going back into that skyscraper the second the fire alarm shuts off. You are confident you're safe, without ever bothering to smell the smoke creeping through the vents. Which leaves us with a final lingering thought for you to explore on your own. We've just spent this deep dive examining how the smartest, most complex financial algorithms in the world are currently confusing administrative delay with a permanent solution. If the most sophisticated institutions on the planet can fall into that trap, where in your own life or business might you be treating a temporary pause like a deadline extension, a postponed meeting, a quiet period in a conflict as a guaranteed victory?
It is a vital question to ask, especially when the structural conditions beneath the surface haven't actually changed at all.
Something to think about the next time the alarm stops ringing. Thank you for joining us on this deep dive. Keep questioning the consensus, and we'll see you next time.